Hi, I'm Lindsay Alexander, and this is mybanktracker.com. When you were a kid, you probably had some sort of piggy bank at some point in time. You put all the coins and dollars in that piggy bank that you got, and when the time came to get that money, you shook the piggy bank and that's it. If you put every cent of your allowance into that bank and didn't spend it over time, you would have saved a couple of $100s. But the only money inside that bank was the money you put into yourself. This is a lot like putting your money into a savings account at your local bank. The bank may pay you interest on your account, and interest rates on savings accounts are low, and the amount of money you'll have will increase at a very slow rate. And what exactly is investing? Well, it refers to the act of using your money to buy some sort of financial product or another item in the hope and expectation that the product will grow in value after you buy it. If the product does increase in value, you can sell it for a profit. Some investments are only meant to be held for a long time before they grow, such as money you may invest now to use later when you retire. Other investments are more short-term. You may buy one now, hold it for a year or less, and then sell it. Some people take the money they earn from these short-term investments and reinvest in other investments. And there are many types of investments out there. Almost anything you buy now that you can think that can sell more money later is considered an investment. This would be something like real estate, collectibles, stocks, and bonds. A stock is a share of ownership in a company. The value of a share of stock fluctuates daily based on the company's earnings, profit potential, the general economy, and other factors. People who invest in the stock market generally buy shares in a number of different companies and hold them for a long time. A mutual fund is a group of stocks that is selected and managed by a professional money manager. Investors buy shares in the mutual fund, and the manager has the task of buying and selling the individual stocks in the fund to try to make the overall value of the fund grow. The stocks in a mutual fund usually have something in common, such as being from companies that relate to the energy sector. A bond is a financial product that you buy at a set price, hold for a specific period of time, and then redeem at the bond's maturity rate for a gain, which is set by the terms of the bond, and the bond may pay periodic interest during their lifetime or may only pay out at the end. However, there are some risks that the product or item will lose value instead of gain over time. Some investments, such as bonds, have very low risks because they have set terms govern payout. Buying individual stocks is more risky because their value depends on the stock market, which is very difficult to predict. Mutual funds are somewhere in between, depending on the fund and the types of stocks in it. Generally, riskier investments have a greater potential for growth or loss. Low-risk investments do not earn the investor as much money, but the money they do earn is predictable and secure. If you want your money to grow a substantial amount, you should invest. I'm Lindsay Alexander with mybanktracker.com, and together we're going to build your finances and rebuild the world.